Welcome to another deep dive. Today we're tackling financial literacy, and I'm so excited to explore how a solid understanding of personal finance can help all of us make those informed decisions and build a secure future. And the best part is it really doesn't matter your income level. We've got a really interesting mix of sources, including a super insightful YouTube video. It breaks down those complex concepts into bite-sized pieces. And get this,
Okay.
one of the sources actually highlights this fascinating paradox. Americans are wealthier than any other population in history,
Wow.
yet so many struggle financially. Why is that? Let's dive in.
That's a really great question.
Yeah,
And it gets to the heart of why financial literacy is so crucial. It's not just about how much you make, but how you manage it.
right. So true. It's like having all the ingredients for a delicious meal, but not knowing how to cook.
Exactly. So let's lay out the essential elements of financial literacy. Think of it like a toolbox
I like that.
filled with knowledge and skills.
So what tools are we putting in this financial toolbox?
First, you need the basics for managing your day-to-day finances. So budgeting, tracking your expenses.
Right.
Then there's understanding different types of debt. Mortgages, car loans, credit cards. They each work differently and carry different levels of risk. And of course, we can't forget about saving for those unexpected life events.
Absolutely, because those surprise expenses always seem to pop up at the worst possible time. A flat tire, sudden medical bill. Those can really throw a wrench in your plans if you're not prepared.
Absolutely. And once you've got a good handle on those foundational elements, we can start exploring the exciting world of investing.
Ah, that's where it gets interesting. But before we jump into investing, one of the sources brought up this concept called the law of comparative advantage. It's kind of intimidating at first, but I think I'm starting to get it.
Yeah.
Can you break it down for us?
Yeah, it's a really powerful economic principle. You can actually apply it to personal finance as well.
Okay.
Essentially, it means focus on what you do well and what others value.
So it's about finding that sweet spot where your talents and skills, align with the demand in the market.
Exactly. Let's say you're really great at fixing things around the house. You could spend your weekends, doing those DIY projects, saving money, not having to hire professionals.
Yeah.
But if your time is better spent focusing on your career, where you earn a higher hourly rate, it might make more sense to hire someone for those repairs and use that freed up time to advance in your career. It's about making strategic choices.
That's a really great example. It really helps to connect this abstract economic principle to everyday decisions.
And this applies to career choices as well. You'll be much happier and more successful in the long run if you choose a career path that aligns with your strengths and interests.
Absolutely.
Think about what you enjoy doing, what you're naturally good at, and how those skills can translate into a fulfilling and financially rewarding career.
Yeah. Speaking of finding your strengths, there is this inspiring story in the YouTube video about a successful entrepreneur built a thriving business from scratch. What struck me was their emphasis on hard work, planning, and smart financial decisions. It really resonated with me, even though I'm not an entrepreneur myself.
It's a key takeaway. You don't have to own a business to benefit from that entrepreneurial mindset. It's about being proactive, taking ownership of your finances, and making deliberate choices that align with your goals.
Yeah, it's about being intentional, not just letting things happen to you.
Right. It's about recognizing that your skills and knowledge have value and that you can use those assets to create a better financial future for yourself. And remember, you get paid for creating value, not just for effort.
That's such an important point. It's not just about working hard, it's about working smart. Even in an entry-level job, consistently going above and beyond, taking initiative, developing valuable skills,
Yeah.
that can make such a difference in your earning potential.
It can. Absolutely. It's about being strategic and recognizing those skills and knowledge are valuable assets.
Okay, this all makes sense, but let's be real. A lot of us struggle with, managing expenses. I know I do. It's so easy to overspend.
You're not alone.
Yeah.
One of the sources highlighted a really common problem. A lot of people just don't know where their money goes each month. It just seems to vanish.
Right. It's like a magic trick. One minute it's there, the next it's gone. Poof.
That's why tracking your spending is so crucial. It gives you a clear picture of your financial habits, helps you identify areas where you might be overspending without even realizing it.
And once you have a good grasp of where your money's going, you can start creating a budget, right? The source mentioned this simple framework called the 50-30-20 rule. Seemed like a good starting point.
It's a great framework, and it's pretty easy to remember.
Yeah.
You allocate 50% of your after-tax income to necessities. Those are the essential expenses like rent, utilities, groceries, transportation. Then 30% goes towards your financial goals, like paying off debt or saving for the future.
Okay.
And the final 20%, that's for personal spending. So that's the fun stuff. Entertainment, hobbies, dining out, travel.
I like how this framework, acknowledges that while it's important to be responsible with your money, it's also important to enjoy life.
Yeah.
You're not just working to pay bills. They're working to create a life you love.
Exactly. It's all about finding that balance, meeting your needs, pursuing your goals, and enjoying the present moment. What happens if you don't budget?
Okay, I'm a little nervous, but I know it's important.
One of the sources paints a pretty vivid picture of the downsides. Without a budget, it's easy to fall into that trap of playing catch up.
Oh, that's a feeling I know all too well.
Mm.
Like you're always one step behind, scrambling to pay off past purchases, never quite feeling financially secure.
You're constantly reacting to financial challenges instead of being proactive, and it can be really stressful. It prevents you from enjoying that hard-earned money.
I imagine it can also make it really hard to achieve your financial goals. Like, if you're constantly paying off credit card debt, you have less money to save for a down payment on a house or invest for retirement.
Exactly. It creates this vicious cycle, can be really difficult to break. And it's about building those positive financial habits that lead to long-term security and peace of mind. That brings us to the next crucial element, building assets.
Assets, those are the things that work for you, right?
Yeah.
Like little financial
That
superheroes.
was not that analogy. Yeah, assets are things you own that have value, and they can generate income, appreciate over time, or both.
Okay, so a savings account's an asset because
Uh-huh.
it earns interest. A house is an asset because its value can go up.
Exactly. Even your car, while it generally depreciates, is still an asset because
Yeah.
it provides transportation and has a resale value. The source material really emphasized that building assets is crucial
Yeah.
for achieving that financial security.
One of the sources I remember talked about how saving is like habit forming,
Hmm.
and even small amounts consistently saved can really add up.
It's a key takeaway. It's not about making this huge lump sum investment. Building wealth is more like a marathon
Hmm.
than a sprint,
Yeah.
and consistency is key.
Yeah. Small, consistent steps repeated over time lead to big results. That's a concept that applies to so many areas of life.
Absolutely. And there's a simple trick to make saving easier. Automate it.
Oh,
Treat your savings like a fixed expense, like your rent or utilities.
okay.
Set up an automatic transfer
Yeah.
from your checking to your savings each month.
Oh, that's a great idea. Like it takes the decision making out of it. So you're less likely to spend the money impulsively. And I also love the tip about setting up separate savings accounts for those unexpected expenses.
It's a really smart strategy. You can have one account for your emergency fund, another for car repairs, maybe even one for a future vacation. It helps you stay organized and ensures that you're prepared for whatever life throws at you.
Right. And speaking of being prepared, let's move on to investing. The source material covered a lot of ground here, but one word really stood out to me. Diversification.
Diversification is one of the golden rules of investing. Remember that analogy about not putting all your eggs in one basket?
Right. If that basket drops, you lose everything.
Exactly. So when we talk about investing in the stock market, you're talking about buying a piece of a company, becoming a part owner, sharing in the company's profits. But like any investment, there's risk involved.
Yeah.
A company's stock price can go up or down, and there's always a chance that you could lose money.
Right. But with diversification, you spread your investments across many different companies, so that reduces your risk, like having a safety net.
Exactly. And there are some really simple and accessible ways to diversify, even if you're just starting out with a smaller amount of money.
Okay. I'm all ears. Tell me about those.
Have you heard of index funds, ETFs, or mutual funds?
They sound familiar, but I could definitely use a refresher. What are they and how do they work?
They're all ways to invest in a basket of stocks, bonds, or other assets. Gives you instant diversification. It's like buying a slice of the entire stock market instead of trying to pick individual stocks.
Okay. That makes sense. It feels less intimidating than trying to research and choose individual stocks myself.
It is, and the source material used a great example, the S&P 500.
Oh, yeah.
That's a really popular index fund. It tracks the performance of 500 large companies listed on stock exchanges in the U.S. It's considered a benchmark for the overall U.S. stock market.
So by investing in an S&P 500 index fund, You're essentially owning a tiny piece of each of those 500 companies.
That's a great way to think about it. And with index funds, ETFs, and mutual funds, you benefit from professional management.
Hmm.
These funds are overseen by portfolio managers. They make investment decisions based on research and market analysis.
So it's like having a team of financial experts working for you.
Exactly. And remember, investing is a long game. Markets can be volatile in the short term, but over the long term, history has shown that investing in a diversified portfolio,
Yeah.
one of the most effective ways to build wealth. It's important to ride out those ups and downs, stay focused on your long-term goals.
Right. Speaking of the long game, remember seeing that quote from Einstein about compound interest being the most powerful force in the universe?
He wasn't exaggerating. It's one of the most remarkable concepts in finance.
Break it down for me. I know it's important, but I'm not sure I fully grasp how it works.
Imagine you invest $100 and earn a 5% annual return. With simple interest, you'd earn $5 each year. So after 2 years, you'd have $110. But with compound interest, you earn interest on your initial investment plus the interest you've already earned.
Oh, okay. So it's like your money is multiplying itself. Magic.
It is a bit magical. In year 2, instead of earning 5% on just the original $100, you're earning 5% on $105. And that difference really starts to add up over time.
The source material really emphasized how starting early makes a huge difference. Like it could mean hundreds of thousands of dollars over a lifetime.
It's true. Time is your greatest ally when it comes to compound interest. The earlier you start, the more time your money has to grow. And compound. Even if you can only invest a small amount right now, starting early is one of the best things you can do.
It's like planting a tree. Best time to plant a tree was 20 years ago, but the second best time is today.
That's a great analogy. And there's a concept called the time value of money. It's closely related to compound interest. It's the idea that a dollar today is worth more than a dollar in the future because of its potential earning capacity.
So the money you have now can be invested and grow over time. But the money you owe, debt, that can also grow due to interest. Time can work for you or against you, depending on how you manage your finances.
Exactly. It's a powerful concept to keep in mind as you make those financial decisions. Now, we've talked a lot about assets, so let's explore the flip side, liabilities.
Liabilities, those are the things we owe, right? Like student loans, car loans, and those pesky credit card balances.
That's right. Liabilities are obligations you owe to others. They represent future payments that you'll need to make, which can impact your cash flow and limit your financial flexibility. But one of the source materials made an interesting point. Credit can be both good and bad.
Well, that's an important distinction. I know credit cards can be dangerous if they're not used responsibly, but they can also be helpful for building credit, earning rewards.
Exactly. Using credit wisely can be a really powerful tool for building wealth and achieving your goals. For example, taking out a mortgage to buy a house can be a good use of credit because you're investing in an asset that will hopefully appreciate in value over time.
So it's like you're using credit to leverage your resources and build something valuable. But what about using credit for things like vacations or, new gadgets?
That's where it can get a little tricky. Using credit for consumption. For those things that provide immediate gratification but don't necessarily build long-term value, that can lead to a cycle of debt. The YouTube video had this really great analogy. Imagine buying pizza with credit.
Okay.
So the pizza's gone, you enjoyed it, but now you're poorer because you owe money for it.
Right. And if you're not careful, the debt can snowball.
Yeah.
Especially with those, high credit card interest rates.
Absolutely. And the emotional burden of excessive debt can be just immense. The stress, the anxiety, a feeling of being trapped, it can impact your well-being. One of the sources highlighted how debt can drain people's joy and steal their hope. It's this powerful reminder that financial health is connected to our emotional and mental well-being.
It's a reminder that our financial decisions aren't just about numbers. They have a ripple effect on our lives in so many ways. So as we wrap up this deep dive into financial literacy, what are the key takeaways you want our listener to remember?
I think the most important takeaway is that understanding the basics of income, expenses, assets, and liabilities is really essential for building that secure financial future. It's the foundation upon which everything else rests.
It's like building a house, right?
Yeah.
You need that strong foundation before you can even think about putting up the walls and a roof.
Exactly. And once you have that foundation, you can start implementing those smart strategies, budgeting, saving, investing, and really create a life of financial freedom.
And let's not forget about avoiding reckless debt and using credit responsibly.
Absolutely. Debt can really weigh you down. It can prevent you from achieving your goals. And it's crucial to be mindful of your spending habits. Make conscious choices about how you use credit.
One of the things that really struck me in the source material was how many people avoid talking about money because they're afraid of sounding uninformed or making a mistake.
It's true, there's often a stigma around money,
Yeah.
and people feel embarrassed or ashamed to admit they don't know everything.
Which is totally understandable. Financial literacy is a journey, not a destination. We're all learning and growing, and it's okay to ask questions and seek guidance along the way.
Absolutely. That's why it's so important to create a safe and supportive space for these conversations.
Yeah.
Talking about money openly and honestly, help us learn from each other, break down those barriers of shame, and empower ourselves to make better decisions.
So for our listener out there who's been soaking up all this knowledge, we have a challenge for you.
We love a challenge.
Start a conversation about money with someone you trust. A friend, a family member, a mentor, a financial advisor. Share what you've learned. Ask questions. And don't be afraid to admit what you don't know. You might be surprised at how much you can learn from each other and how empowering it can be to talk about money openly and honestly.
I love that challenge. Breaking down the silence around money is so important.
Right. Imagine the ripple effect it could create.
I know.
Exactly. It all starts with a conversation. So go out there, start talking about money, and empower yourselves to create a brighter financial future. Thanks for joining us on this deep dive into financial literacy. Until next time, keep learning, keep growing, and keep those conversations going.